Thank you, Chris. It's a real pleasure to moderate this panel on real-world asset tokenization today, where we'll have the opportunity to discuss with two experts in the field, Luc Falempin and Nicolas Garcia. The first one is the founder of Tokeny, based in Luxembourg. Welcome here, and thanks for joining us. And we have Nick Garcia, who is the founder and CEO of Fortunafi. Thank you very much, guys, for joining us today. I guess we will start by a little bit of a context, and especially the fact that we hear on a regular basis that there is quite a lot going on tokenization, and especially these last few years. In Luxembourg, we see quite a lot of use cases where it has been developed and constitutes a new craze, especially with the introduction of the terminology real-world assets. We already had tokenization in real estate in Luxembourg. Instead of giving you the definition, I want to ask our panelists what is their take on it, and whether they could provide us with some specific elements of understanding. So I will start with Luc. It's the educational minute. Could you please explain in intelligible terms what does tokenization mean?
Sure. So first, thank you for having me. So tokenization is the process to represent assets on the blockchain. So we create digital keys on the blockchain to represent any type of assets, virtual asset or real-world asset now.
Okay, and is there a need for a specific infrastructure to do that, or is it just on any kind of blockchain?
So it can be any kind of blockchains, and there are different technologies for blockchain networks. So over the past years, we've seen a lot of different things: private blockchain, permission blockchain, public blockchains are different categories. But for tokenization, any type of network can be used.
Okay, thanks for this clarification. And Nick, now I would like to have a better understanding of what is the meaning of real-world assets. What does it mean, and what are the use cases?
Yeah, so look, I think, I may be the first to, maybe not the first, but certainly will admit that I think real-world assets is not the best name for this, but lo and behold, it has taken off over the last couple of years. As you've mentioned, Emily, that, folks used to call this tokenized securities, tokenization. There's folks calling it now off-chain assets. I think, Luc's description is very accurate, right? Ultimately, it's a traditional asset, right? Whether it's a publicly traded asset or a private asset, it sort of fits a lot of different types of assets, but effectively it's a non-native crypto asset that's being represented on-chain through some form of a legal and technical infrastructure that's being implemented in the back end. And really, what's happened over the last couple of years is you've had this proliferation of stablecoins and DeFi and additional layer ones and layer twos that have really opened up the opportunity for users and enterprises and different institutions to create new products on chain with very familiar assets that allow users to get actual more utility from it, now that we have sort of this concept of decentralized finance, which is really just financial services on chain in slightly different mechanisms that have more distribution to users globally. But I'm sure we'll get into more of that as well. But yeah, it's effectively off-chain assets tokenized on-chain.
And what is the use cases that you're currently observing and that could make sense, speaking of real-world assets?
Yeah, so, as we've sort of alluded, there was this initial attempt to bring these assets on chain back in 2017, 2018 that ultimately failed. There really wasn't the correct infrastructure. It was really just Ethereum back then. You didn't really have this proliferation of stablecoins and decentralized finance as you do today. And really now coming into the end of 2023, what we're seeing is there's numerous different layer ones and layer twos and numerous different decentralized applications built on those layer ones and layer twos that are looking to drive new use cases and sort of enhanced use cases that they've already been doing. So one of the major assets that have been really picking up steam are US Treasury bills. Naturally, with the existing macro environment, the rate on these T-bills have been very attractive, giving the risk relative to the reward. It's been a very high adoption asset. We've seen stablecoins adopt these as collateral. We've seen users hold these instead of stablecoins. We've seen permissionless trading venues use these as cross-margin collateral. We're seeing a lot of new use cases. A lot of it has started with these T-bills, but it's certainly moving over to additional types of publicly traded assets, right? Asset-backed securities, securitizations. There's a number of different publicly traded assets that are now also being brought on chain, but I think there is going to be sort of a big proliferation of private debt assets as well that are brought on chain to find more efficient sources of liquidity. But certainly T-bills has been the dominating asset this year for sure.
Thanks for this clarification, Nick. What is your take on this, Luc? Do you observe the same thing, or is it a little bit different here in Europe?
Yeah, for sure. On chain, we see more and more T-bills because today it pays you 5% annual yield, and on Aave with your stablecoin, you get 3%. So for sure, if you launch some kind of tokenized T-bills, you can attract a lot of people owning stablecoins or crypto who can get in your financial product quite easily without passing through the traditional banking system. So for sure, more and more T-bills. We see some money market funds now, which are quite simple to tokenize, I guess, and very liquid, and that you can use even as stable coins step by step. So it's very interesting. But historically, we've seen a lot of different type of assets. A lot of real estate. Now the market is a bit slowing down on the real estate side, so we see more and more private debt. We always had a lot of funds, different type of funds, open-ended funds, closed-end funds. Technically, you can tokenize anything you want. So then it depends the use case you want to bring to the market.
And Nick, you're based in the US. What is happening there regarding tokenization, especially the fact that there is a discrepancy between the regulatory framework in Europe, in the US? It's not going at the same speed. So what is your observation at the moment?
Yeah, so certainly, I mean, I think it's pretty evident that Europe and sort of other geographies outside of the US are moving substantially quicker than the US. It's pretty evident through the laws that have been put in place, through Luxembourg, Switzerland. I mean, there's more and more locations coming up that are creating effective frameworks for tokenized securities. I think in Europe you're seeing a lot more of a direct tokenization of the underlying, right? So the token represents a ticker in particular, and that's sort of the way that the regulation is being allowed, and sort of that's how it's scaling in Europe from my perspective. In the US, you don't have these new regulations, right? So you have to sort of fit into the existing framework. I do think things will change over the next few years. I think there needs to be some shifts in the government, which I think we're having elections next year, and so we'll hopefully see some improvements there. But we do have the framework of the Investment Act. From there is the private fund section, which has different exemptions, and there are mechanisms to create very scalable forms of tokenized securities through these existing regulations. They're naturally not they're not the most efficient mechanism, right? If I were to say, I think if we were to enable tokenized public funds to exist within a regulatory framework, that would be the next major step, I think, in the US. But for now, the private fund framework certainly works, and we can create transferability using that framework and maintain full regulation and compliance. So I do think the US needs to make a significant amount of improvements. Hopefully we do get some regulations over the coming years that will sort of change that. But there are mechanisms in which we can scale this industry today within the US, and that's one of the things we're focusing on here at Fortunafi. The product that we're launching here very soon is open to both US users and international users that go through KYC, AML, and then they're able to sort of onboard and utilize the product. So it's really trying to think of the product from a global first perspective rather than a US or Europe perspective.
Okay, and I guess as in every industry, especially in the tech environment, there are some limitations or some missing elements that make difficult the adoption. What are at the moment the limitations in the tokenization world? Luc, maybe if you want to start.
So I see different problematics that we still need to solve. The first one is to have the cash leg on chain. Of course, you have some stable coins, but they are not credible enough yet for the banking infrastructure, the financial institutions playing in that field. And the other main area is really this lack of compatibility with the traditional banking system. So basically, if you tokenize, a lot of different players don't know how to handle your tokens, don't know how to distribute them, to collateralize them, to do anything with them, to service them. So this is progressing step by step. Tokens after tokens, you have new players who understand how it works and how they can handle this new digital things. But there's still a long way to go. So I think the stablecoin part can be fixed quite quickly. Now the regulatory landscape is progressing, even in the US, they are discussing this. So hopefully it will change soon. In Europe, we have MiCA, which is clarifying a bit for stablecoins. Maybe the part that is less clear, but at least it's better than before. So really, we need some large actors tokenizing cash, first for their clients and then to open the system to others, and it will change drastically the industry, I think.
And what is your take on the fact that we hear that securities are the ones that are tokenized in Europe? In the US, it's pretty much nothing that can be tokenized or that is tokenized, and in Asia, it's pretty much everything. Is it something that you're viewing on a daily basis?
Yes, I think it's true because in Europe, we have a clear understanding now about this new instrument. And basically, if you tokenize securities, they are still securities. So that's quite clear for all players. In Asia, there's still a bit there's differences between RWA, STO. Is it a new thing? Is it the same thing? And securities laws are most of the time a bit less advanced than what we have in Europe. So it's a bit more the Wild West, let's say. And in the US, it's quite difficult because the large players don't know if they can use public blockchains or not. Mostly because they are not really authorized to hold crypto to pay their gas fees or that kind of things. So there are a lot of doubt still in the US to use these public blockchains. So it's true that more and more we have clients in Europe, but historically we made some tokenization projects all around the world. So it's not such an issue when you have the right technology, because you have securities laws and we can enforce all of these laws as regulations on chain. So none of our clients got any issue with that.
And Nick, yes, sorry.
I do want to jump in with some just quick comments there that I think there is some misconception around what's going on in the US right now. So just some data points that I think are helpful. I'm sure most people are familiar with Franklin Templeton, right? They are one of the largest institutions in the world. They happen to be one of the largest issuers of tokenized securities on permissionless blockchains. From my understanding, they currently are issuing on Polygon. They currently have one of the largest TVLs of any issuers, period, on chain. I think it's in the 300 million sort of range. And so, just contrary to what I'm hearing, more broadly, sometimes online, sometimes, in private discussions, but there is quite a bit of activity in the US, right? Despite there not being a new regulatory framework to enable the actual tokenization of the specific securities, there are existing frameworks that can be utilized, which is what I was talking about earlier, specifically the Private Fund Act, which is sort of a subsect of the Investment Act that enables, private funds. There's different exemptions that allow this, but I just do want to point out there are large, very well-known institutions that are already live in the space with size. Pretty much every single other institution, from Citibank to JP Morgan to Bank of America, really across the board, are all looking at this very actively and very close to launching products. A lot of them do have products that are intrabank that are live today. There's quite a bit of volume actually going on the intrabank activity as well, but that is going to scale even more to permissionless blockchains. So I just do want to clarify that there are mechanisms to enable not just US users, but US institutions to tokenize these assets. And there are large players that are already live, such as Franklin Templeton, that are doing this today.
Thanks for giving us your insight on the US way of doing things. And we discussed the fact that tokenization is there for quite a while already, but still RWA is the thing that made it appear quite frankly in the media. We're hearing about it like on a daily basis. Why is there such a craze, in your opinion, Nick? And which need is it filling?
Certainly. So I think, there's a very interesting sort of macro environment going on right now where you're seeing these T-bill rates continuing to go up. You're seeing, existing yields in DeFi, which were historically significantly above the off-chain rates, coming down quite a bit, just as risk comes down and activity comes down and sort of the industry resets again. So you're seeing this, there's sort of this macro environment where the rates are in fact now higher and there are more attractive scalable products off-chain than on-chain today for yield specifically. But compounding the fact that there is now like a very big ecosystem of protocols. And when I say protocols, I mean, they're effectively tokenized infrastructure, but really businesses, if you will, that are decentralized naturally, but that are producing significant amount of capital. So you're seeing stable coins like MakerDAO, you're seeing stable coins like Note, which is live on a blockchain called Canto that are now being backed by T-bills. And this is going to continue to proliferate. Even Frax, which is a pretty large decentralized stablecoin, is now also onboarding T-bills. And so what you're going to get is this revolution of, if some of you may have heard of, DeFi Summer, which was an early sort of growth of users and activity in decentralized finance on chain. We believe there's going to be sort of a next phase of that really is using RWA or tokenized securities, whatever you want to call them, as sort of that base collateral within these protocols to start earning a significant amount of yield. So one quick example with the product that we're going live with Canto is you'll be able to, either US or offshore users will be able to mint T-bills directly and onto various different blockchains. But one of these first use cases is enabling 10 plus leverage on T-bills, right? Which is something that's quite difficult to do. I spoke with a financial advisor that recently helped their client get some leverage against a portfolio of T-bills. I asked them about the rate and the LTV. And this is a scenario where the client needed to do this for purchasing a home, sort of a big purchase, so it was okay. But it would have been a much more efficient transaction. It would have been a cheaper borrow than the yield on the T-bill, and they would have gotten a much higher LTV. So they would have made a more profitable transaction just simply by being on chain. So I think these use cases are growing, and more it drives new users directly on chain through applications that'll abstract some of the complexity of operating on chain. But ultimately, the benefit here is it drives more value to users directly, which is what will drive these users to sort of come into this ecosystem. It's what we've been seeing pretty actively over the last year.
That brings us to the next question I had for Luc, actually. When we launched the tokenization, and I think you were one of the first in 2017 to launch one of these platforms, I had in mind that it was also to solve the issue of distribution and liquidity of these markets. Is it now an issue that is solved? Is it a problem from the past, or are we still experimenting a little bit of difficulties in these two areas?
I think it's still the end goal, but we're not there yet. Most of our clients, large financial institutions, really benefit from tokenization on the operational side, so to gain, to make efficiency gains, basically, in their operations, to move assets faster and that kind of things. But the distribution and liquidity side is not there yet. Why? Mostly because we are lacking good tokenized assets. The good tokenized assets are just a few. You can count them on your hands for the moment. So we need a massive influx of good assets, regular assets tokenized in a compliant way with the same standard to make sure that this is happening. What we've done is to create this technical standard, open source, and to make sure that a galaxy, a full ecosystem of applications, trading venues, service providers, etc., are compatible with this same standard. So step by step, we are getting there. And now when you tokenize with this standard, indeed, you have, I think it's like 15 centralized exchanges. It's compatible with any DeFi protocol. You have some digital trading desk. So step by step, we're creating this ecosystem. But we need much more tokenized assets in order to create the supply and then the demand and then the supply, and then you enter in the virtuous cycle.
That leads to the question as well. We are observing a lot of financial instruments being tokenized and being digital twins. While in the idea of blockchain from the beginning, it was really to create digital natives. Mm-hmm. Is it like a problem, or is it something that we want to have actually a digital twin of financial instruments, or are we willing to move to something more digital native?
So I'm not sure it's an issue. So most of our customers, indeed, they create digital twin or whatever we call it, but basically the token is not the security itself, it's a proof of ownership. And any movement on the blockchain will be reflected with our tools on the cap table. So at the end, it's the same, except if you natively say my token is my security, it brings a lot of questions. And there are just a few countries in the world where you can do that, and with some constraints. Luxembourg is one of them. But most of the time, it's just a proof of ownership. and therefore you can use it, leverage it with the same conditions without making it a big deal where you need to change all of your contractual agreement with all of the investors, the service providers, etc.
Okay, and it's already time for our last question. And this is for both of you, actually. I'm taking the crystal ball on the stage, and I would like I think we all agree that RWA tokenization is really something that is about to take off or is taking off. But there are still elements that are missing. So how do you see RWA tokenization in 2 years' time? And I will give first the mic to Nick for this question.
In 2 years' time is an interesting question. And in 10 years' time is an even better question. I think in 2 years' time, we see, currently we're at about 1.4, 1.5 billion. That does change pretty frequently, but in the 1.5 billion range of tokenized RWA, tokenized securities, whatever you want to call it, on chain today. I think in the next 2 years that easily quadruples. And I think that's just really existing adoption of these tokenized assets with the industry today. So a lot of existing users, there are a lot of net new users coming in, but it's really the distribution of being able to use these assets on chain with these different protocols. I think 2 to 10 years out, what you start seeing is these institutions coming in size into the infrastructure that's been built in these first 2 years to provide additional utility for their clients and more efficiency for their internal operations. And so I think these next 2 years are really all about building the infrastructure that's needed to support this massive growth that will likely go from 4 billion to 30 trillion from that 2 to 10 years out, right? So we're talking about absolutely massive scale. This will significantly grow the crypto ecosystem. It's one of the things that are sort of necessary in order to bring this digital ecosystem to the next level. It's obviously not very scalable when you have just internally recursive assets, which is what we had back in 2017, 2018. Bitcoin, ETH, just purely digitally native assets. Now being able to bring in these additional high quality assets that have yield and can be used as the basis of a lot of these different applications on chain today is what really enables this next leg of growth. So I think we go into the 4 billion type of range in the next couple of years, and from there to 10 years out, I think we're going to have like a hyperscale into sort of the 30 billion type of range.
Okay, and Luc, in your mind, what is going on in 2 years' time, and what is the real use cases that you would like to see develop?
I think it will go faster than what we think, because now we have the right blockchain technologies and infrastructure, we have the right token protocols, we have the right providers, and mostly now we have some big names, BlackRock and others, saying we are going. So of course there are large financial institutions, they need time to get organized, etc. But they are already starting. We already work with large banks, asset managers, they are all working actively on this type of projects. So in the next 2 years, yes, they will start tokenizing regularly good assets on public blockchains in a compliant way. So I think it will drastically accelerate the ecosystem. But what I would like to see tokenized in the short term is loans. Why loans? Because you can do thousands of loans. It's usually short term. It's a small tickets. You can divide all of this. So if we have these thousands of loans suddenly on the market, people will start really playing with these tokens, do a lot of things with these tokens, and we will really see the value emerging. So that will be quite fun.
Well, thank you, Luc. Thank you, Nick, for this insightful panel. And now I will hand over to Chris.